Welcome back to Successful Living. We're joined by Steve Tetzner, Vice President at Homestar Mortgage. Welcome, Steve.
Thank you.
And with mortgage rates, I always say this, being better and better every single month, it seems to me, and I'm sure you'll tell us a little bit differently. Can you tell us currently, like, what is the mortgage rates, or not even the rates, what's going on right now in January of 2020?
Well, we started the year off with a rate drop, which was very surprising, but it was a result of some world events that have occurred. And so we saw the 30-year rates dip back down to the lows that we saw back in the fall of 2019. So the 30-year mortgage rate is now in the mid-threes, around 3.5%. The 20 years down around 3.25%, and we're seeing the 15-year back down around 3.0.
Wow. Okay.
Yeah.
And you had mentioned the fall of 2019. If we took the last, say, 5 or 6 years, was there any, is this kind of the lowest point, or we're pretty close?
We're pretty close, yeah. I would say that in the last 5 years, we're probably at about the peak low.
Great.
Or equal to.
Okay. And then what do you see going forward in 2020? And I know you can't project. Everyone in my industry goes, oh, Rob, what's going to happen with the stock market? I have no idea, but I can talk a little bit about it. So I'm just wondering your opinion or just some thoughts of what's ahead of us in 2020 for rates.
For the real estate industry and mortgage rates, I think that they're going to be okay going into the spring. I think that if we see some more positive signs out of the economy, I think that we could see the rates actually increase a little bit. I'm really skeptical about fourth quarter going into the election.
Yeah.
Going back to 2008, when we moved into that election cycle, the economy just shut down. And with a lot of the controversy out there, I'm just wondering how that might affect our business this year.
Okay, and that is what, when the Fed actually meets for interest rates? Is that what you're saying around election time?
Oh, no. I'm concerned about people with the presidential election kind of saying, well, let's wait and see.
Oh, right.
And, wait and see what the 2020 election brings before they make a big jump and, buy a bigger house or sell a house or do something dramatic without knowing who's going to be leading the country going forward.
And I think that makes sense in both our industries or in any industry, really, anytime you're going to make a big move. So we were talking about PMI, which is...
Everybody hates PMI.
I had it at one time, I hated it, but then I forgot what it was, and then you and I talked earlier and you reminded me what it was. So what is it, first of all?
Well, PMI is a lot of misconception. What PMI does is if a borrower is not putting 20% down, it is an insurance company that is coming in and sharing the risk of default with the lender, usually Fannie Mae or Freddie Mac. So in the event that the customer defaults on the mortgage and there's a loss incurred, Fannie will share that risk loss with this private insurance company. Okay. It does not benefit the borrower in any other way than without it, they wouldn't be able to obtain the loan. It doesn't mean if they're out of work, somebody's going to pay their mortgage for them. That's a very big misconception. Or if they pass away, their mortgage will be paid off. That's not what it is.
So it's for people that, and the reason I think why it's out there, I'm just kind of thinking it through as you're talking about it, is they didn't have enough money to put down at least 20%.
Correct.
So the person who's the original mortgage company is saying, I need some help here if they default on it.
The lender, which is usually Fannie or Freddie. And then, even on the government side, the government functions as a private mortgage insurer through VA, USDA, and the FHA.
Okay.
So all those entities are doing is the same thing as the private mortgage insurance company, where they're guaranteeing a portion, or in some cases all of the loss of the loan, to the private lender, Fannie, Freddie, or Ginnie. So when you're dealing in the private mortgage insurance market, there are ways to circumvent it, to make it lower. There's been a lot of significant changes with PMI over my 25 years in the industry.
How is it? What's a simple way we could tell viewers the way it's kind of calculated? Like, how do they come up with that premium amount? So
the premium is based on a factor. So the factor that a person pays is based on their credit score.
Okay.
Based on their down payment, 5%, 10%, 15%. It could also be based a little bit on the property type, whether it's a single family condominium, the term of the loan, whether it's a 30-year, 20-year, 15-year. So all these factors are considered.
Okay.
And then all of the risk is compiled, and the private mortgage insurance company comes back and says, okay, based on all this criteria, this is the factor that we're going to charge. And then we simply take that factor, whatever it is, say 0.4, and it's a $100,000 loan. So you multiply it out, that's $800, you divide by 12, there's your monthly premium.
Okay. Can the individual purchaser of the house actually choose the company they want for that, or is that done through the mortgage
lender.
process.
Yeah, the
so the
lender.
lender chooses, and I would assume the prices for the most part might be pretty close.
They're very close, but typically what we will do is, because some mortgage insurance companies have a niche where they are a little bit lower in certain types of situations,
Okay.
we'll electronically, with the press of a button, I can shop 3 PMI companies to get the lowest premium for my customer.
So if someone had like poorer credit, you might say, well, this company here is going to give them a better rate, and you're able to choose that for them.
Correct.
Awesome. Okay. Yeah,
Yep.
that makes a lot of sense. All right. So when does PMI go away? And that's always the big question.
Once you have 20% equity in the house.
Okay.
So if you're counting on the PMI going away based on either your original purchase price, or if you refinanced and had PMI, whatever the appraised value was of the property, you should monitor that as a consumer, okay? So you should know that, okay, if my property was worth 200, when my principal balance gets to 160, my PMI should drop off. And you should monitor your principal balance at that point.
Okay.
The lenders are required under federal regulation to drop it. So it is
When?
required under federal law, once it drops below 80% loan to value.
But how do they know the value of the house if it took 5 years to get
It's
to?
based on the original purchase price or the original appraised value of the file.
Okay, so once
if-
it gets to the 78%,
It's
you're good.
100%
So it's that
gone.
2% you could catch much earlier, I'm assuming.
Correct.
And then you could do it. Now, what if house values go up?
You can try to petition to challenge the value of your home and the need for PMI. It's much more difficult to eliminate the PMI that way, because
It
the
is.
lender is going to say, okay, you need to use our appraisal company.
Right.
They're probably going to be a little bit more on the conservative side, and they're going to be looking for a very strong value to be able to drop the PMI. Because what happened is they got burned back, in the heyday when the values were escalating so quickly. They were letting everybody drop their PMI, and then all of a sudden property values slid. And now everybody was underwater with no mortgage insurance, and the lenders took the big hit.
Got it. Okay. Now, if a client, and this was just a question that I had, because I remember when I originally went through this, I actually went and I got, I kind of did the challenge, right?
Yep.
So this is quite a little ways back, but as soon as we get to the 80% of what I thought the value was, they then had their own appraiser come out, and we went and we did that. If it was so far kind of blown up where the market's done really, really well, and it's at 78, and it automatically is terminated, is there any way for them to get that 2%, what they paid during that 2% time, that money back, or no?
They could petition for it. It would be a
could.
small amount of money.
Okay.
Technically, it's supposed to be dropped at the 20% mark.
Okay.
But the government does give the lender just a little bit of leeway in being able to execute the elimination of the PMI. But if they call, their servicer and say, look, when I make this mortgage payment, I'm below 80,
Yeah.
then it has to drop then.
Okay. Now, what happens if, let's say I took my mortgage out and I put 30% down, everything's fine, and then I go take out a home equity line, which then throws me over, and I'm saying now I've got 82% that I've, in a sense, loaned out.
Right.
Are they going to throw PMI on the whole thing, or just a home equity line of credit?
Neither.
Really?
Yeah, so they're totally different supplies of money. So
Okay.
the first mortgage is based on the value and the loan-to-value position of that loan. So back in the heyday, one of the ways that we used to eliminate PMI was with second mortgages.
Oh, really?
So somebody could put 10% down. We called it an 80-10-10.
Yeah.
We'd give them a first mortgage, Fannie Mae fixed rate at 80% with no PMI, a 10% home equity product like a line or a loan, and then 10% down, and they never paid PMI. So that was a way to avoid PMI in years ago. In recent years, the home equity products have come back where we can lend above 80, even up to 95% of the home value with a second mortgage product. Either
Without PMI?
you can do it, but it doesn't. The Fannie Mae has made it such that they've done a pricing adjustment to the loan. If you
okay.
do that, where
So
it
you're
doesn't
still
make
paying
sense to
for
do
it in a sense,
Yeah,
because
so
it's
it's
more
really not worth
expensive
it.
for that loan.
Right, so it's really not
Okay.
worth doing that way. But in the event that somebody was, let's say, looking to purchase a home for $750,000, and they had a home to sell, and they only
Right.
want $500, but their house isn't sold, we can creatively use those products to do what we call bridge financing. So we basically bridge the equity in their current home into the new home until their house sells, and then when they sell their house, they pay off the equity product of the bridge loan, and they're sitting pretty. But they
Yeah.
never had PMI.
Yeah. That's a lot of good information. I mean, originally, if I hadn't gone through it, I knew nothing about it. And you and I talked a little bit before, and I tried to get myself up to speed. And there's a lot of detail in there.
There is.
So one of the things I wanted to flash up on the screen is for our viewers is that they certainly can get more information on this from you directly.
I have an excellent brochure. It's a marketing piece that's put out by one of the major private mortgage insurance companies that I have access to. And if anybody wants to get information about PMI, how to eliminate the PMI, how to challenge it, this is an excellent piece. I can email it it to them or send it to them as a PDF. If they just want to call my office in Providence, Homestar Mortgage, contact me or contact us through Facebook or through the email, I'd be happy to give it to them free of charge.
All right, excellent. So the information is there for our viewers. So I'm just going to go just a tad bit longer here, and I always like to kind of bring us full circle. We talked about teamwork, right? And I wanted to know how it helps you from a perspective of, you know, your business here in Rhode Island, having a good team around you. How does that, you know, you're kind of in charge of the office in a sense, but the teamwork that you have in the office, how does that give you an advantage, do you think, or how does it help you?
It's a tremendous advantage.
So doing it alone is always so, to me, it's so, I need other people.
Every person in my industry that does what I do has a team that they work with. They have an internal operations team that they work with to help to process the loan. Typically an assistant, a mortgage processor, a mortgage underwriter, a mortgage closer, post-closer. We all work together as a team. And, you know, when one of the people in the team is not performing well, it affects everybody. So one of our main advantages is we have long-term employees that don't leave because we have a great atmosphere, and so we have a wonderful team at Homestar.
Yeah, that's great. So I mean, it's really important in every industry. And when I was alone, I now can see the comparison of the two. You get so much more done, and it's more enjoyable to go to work with that. So
absolutely,
thank you for being on the show. When we return, we're going to talk about your portfolio and the expenses associated within your portfolio and how that's going to affect return. We'll be right back.